Hello, as always, my name is Austin Hagaman, and I'm here with Mark Lucci, our co-host for the day, and Jack Manley from JP Morgan. Welcome to Amplified Wealth, Jack.
Thanks very much. It's good to be here.
Good, great. Glad to have you. So Jack is an executive director and global market strategist at JP Morgan Asset Management. He is responsible for delivering timely market and economic commentary to institutional and retail clients across the United States and Canada. He is also a contributor to the JP Morgan Long-Term Capital Market Assumptions and has authored numerous papers on both global and domestic economies and capital markets. Jack is a frequent guest on CNBC, Bloomberg, and BNN, and is often quoted in the financial press. He graduated from the University of Chicago with a bachelor's in history. So, Jack, you studied history at Chicago.
Yeah.
I keep hearing how kids with liberal arts degrees are increasingly having a hard time finding jobs out of school. How did you make the jump from history to the markets?
Well, I'll tell you one thing, Austin. From what I see on my LinkedIn, liberal arts students may be having disproportionately a more difficult time finding employment, but it feels like all young people right now are having a very, very difficult time finding employment, regardless of what they are graduating with. I mean, I actually talked to a guy last week who just wrapped up a PhD program in economics at a very prestigious institution and still cannot find himself a job. So I guess it's nice to know that it's not just the liberal arts kids that are struggling.
Sure.
It really is a broad-based issue that our economy is dealing with. That's, I think, an entirely separate question. But to answer yours a little bit more pointedly, I went into school not really knowing what I wanted to do. My father had studied history as an undergraduate. He then went on to go to law school, as many history majors ultimately do. They go to law school, but then he practiced law for all of 6 months before transitioning and moving over into financial services. And in fact, he worked as a market strategist for about 30 years on the street. So, I had a very rough way of thinking about the job market. It's like you can be a banker, or you can be a doctor, or you can be a lawyer. And I wasn't going to be a doctor, and I wasn't going to be a lawyer. So I guess I was going to go into finance. And I didn't want to study economics because I thought it might be a little bit not too much fun. I couldn't study anything sort of pre-professional because the University of Chicago doesn't offer pre-professional programs. So I said, hey, it worked for my dad, and maybe it'll work for me. I'll study history. And the way that I was able to make it all work is that at the time when I graduated, and I graduated about 12 years ago now in 2013, at the time when I graduated, to graduate from the University of Chicago with a bachelor's degree in history, you needed to write a thesis, not just to get honors, just to get the piece of paper in general.
Sure.
A thesis, 40, 50-page research paper. And I decided to focus my thesis in on early modern English financial history. So like the sort of genesis of central banking and joint stock companies, partly because it was interesting to me, and partly so that if a recruiter asked me the question that you asked just now, I'd have some way to demonstrate that, look, I'm trying to bridge the gap here. But my first job at JP Morgan was actually doing something pretty close to management consulting internally for internal stakeholders. And I think that's a more natural kind of jump from, say, a history major, a liberal arts background, than a jump from a liberal arts background into being a markets and macro guy like what I am right now. That took a little bit more time.
Sure. Very interesting. Yeah, and to your point about all kids having a hard time, finding jobs these days. I guess that's something we'll get into today, based on our pre-show meeting here. But let me put a pin in that, and let's start from the beginning. So the economic data in the first half of 2025 has been all over the place. How do you cut through the noise and figure out what's really happening?
Yeah, a lot of mixed messages, right? I mean, you have a first quarter GDP print that comes in and disappoints, not necessarily relative to consensus, but disappoints just from a sentiment perspective because it was negative, right? I mean, modestly negative, minus 0.5%, nothing horrible, but negative. And in fact, it was the first negative quarterly GDP print that we've seen in 3 years. So it had been a while since we had seen the economy show any signs of contraction. And I remember, I'm sure you remember this too, but like when that first quarter GDP print came out, there were all these people that took that print as a confirmation that all their deepest concerns and fears about all the policy change coming out of Washington, all the noise coming out of Washington was taking its toll on the economy. And hey, here you go, proof positive that we are on the way into a recession, right? But then you got a second quarter GDP print that came in well above trend. And in fact, as of last week, was actually revised even higher from that. We started at 3.0%. The latest reading is now 3.3% on the quarter, with trend economic growth close to 2%. That's more than a 50% premium on what we're used to getting. And so all those, all those worry warts from the first quarter are saying, hey, maybe things aren't so bad. And all those people that thought that these policy changes were the best thing to ever happen to America are feeling vindicated, right? Because now the economy's turbocharged and it's taken off like a rocket ship. And depending on who you are and how you look at the world, you can look at either of those prints and pull from it a whole narrative about what's going on with the economy. And so to your point, Austin, I think it's very helpful to be able to kind of cut through the noise on all this. And, maybe it's my background in history. I don't know, but I think it is always helpful to zoom out and take a bit more of a historical context when it comes to talking about, anything, but this is a good example of where history is helpful. And in this case, really hone in on more recent history, because you put aside the kind of noisy first half of this year. What do we know about this economy? Well, we know that 2024 was an excellent year for economic growth. We know that 2023 was an even more excellent year for economic growth. And we know, perhaps most interestingly, that both of these years where growth was well above trend were years where that above trend growth defied all expectations. You might remember conversations in the early days of 2023. The most widely held view on the street was that at any second we were about to tip into a recession. It's what everybody was saying. And in fact, the economy didn't slow down and actually sped up into the back half of that year and maintained something fairly close to that pace all throughout the course of 2024. This has been a really resilient economy. And that resilience, I think, very clearly comes from the consumer, right? We know consumption is the biggest part of the economy. It's roughly 70% of GDP in any given quarter. It's also been the most reliable, most dependable part of the economy. Every single quarter over these past 4 or 5 years, even including the negative GDP print that we saw in the first quarter, every one of those quarters saw growth in consumption, saw the consumer continuing to spend, and in fact, spending more, at least in real dollar terms. And so when I think about what the consumer is doing right now, very obviously, I don't want to say necessarily a laundry list of problems, but there are a fair number of problems and headwinds that this consumer is facing. You can point to persistently higher interest rates, which is particularly impactful on the mortgage side of things, right? We have home affordability that's quite low if you're not already on the property ladder. You have prices that are quite high and seem to continue to be firming. And we can get into the sort of technicalities of that later if you'd like. But inflation certainly is not great for the consumer. Geopolitical chaos, right? It feels like you get push notifications every 30 seconds on your phone about some horrible new disaster or war or something that's breaking out. So there's a lot of just kind of existential dread, which is never particularly good for sentiment. And then there's a lot of policy change coming out of Washington. You have this administration really changing the game up entirely from top to bottom, a lot going on underneath the surface. And all that churn leads to a lot of uncertainty, whether you're a business owner or an executive or you're an individual looking to consume. So, a lot of pretty obvious, I would say, headwinds that we've been spending a lot of time talking about. But at the same time, we have to remember that this consumer is resilient, right? This consumer has dealt with higher prices and higher inflation and geopolitical chaos and our own domestic policy uncertainty in some capacity for a while. It's also a consumer that's got a lot of tailwinds behind it too. One of those would be where stock prices are right now, right? And yes, I believe at the moment the S&P is off, but we're talking about 63, 64, almost 6,500 on the S&P 500. That wealth effect is real. People feel like they're wealthier, they're more empowered to spend. We talked about property. Well, if you did get on the property ladder before mortgage rates got out of control, the equity in your home is worth a ton. Home prices haven't really moved down. Your mortgage payments are extraordinarily low because you locked in a 30-year fixed rate mortgage of 2.5% or something absurd before the Fed started raising rates. You got a boatload of fiscal stimulus making its way through the system that's really going to start to hit us in the first half of next year, thanks to the passage of the one big beautiful bill a couple of months ago. And then you're having incrementally, I would say, day in, day out, more clarity on policy change, particularly as it relates to trade. The important thing around trade, I would say, is like, look, it doesn't have to be a good news or bad news, a good deal or a bad deal. You just need some news, need some deal, and we're getting more of those as well. So I guess to me, Austin, the big question is, are the headwinds stronger than the tailwinds? Are the tailwinds stronger than the headwinds? I'm not really sure just yet. And I think, unfortunately, only time's going to tell on that. But what I can say, I would say pretty confidently, is that while this economy is pretty unlikely to shoot the lights out like it did last year or the year before because of all those headwinds, it's also similarly unlikely for it to dip into a recession anytime soon because of that existing sort of underlying resilience and all those tailwinds that we should factor in as well. And I guess this all kind of nets out to sort of a boring growth outlook where maybe you see some choppiness as we have in the first half, but it kind of nets out over the course of the year into next as something fairly close to trend. So not horrible, but not exciting or exhilarating either.
You paint this picture of this huge wall of worry, right? I think one of those building blocks on that wall right now that I'm seeing more and more information on is rising credit card delinquencies and the return of student loan payments, putting pressure on certain households. Would you say that these are real cracks in the consumer or just noise in an otherwise strong story?
So fascinating question. They are real cracks for a specific kind of consumer. And being able to kind of parse the data out and zoom in on one particular subset of consumption is critical to dealing with these questions like the one you just asked, right? Because if you look at the American consumer sort of in aggregate, you can take that consumption data and slice it and dice it like a million different ways. But one of the most interesting ones is to track consumption based off of income levels. And the Bureau of Economic Analysis, the Bureau of Labor Statistics, these government bodies that put together these numbers, they actually allow you to isolate these different kind of income bands, right? The top 20% of earners, the bottom 20% of earners, the median earner, whatever it happens to be. They split them into quintiles. And one of the things that you see happening here is that the top 20% of earners in this country spend anywhere between 40 and 60% of all the money that gets spent. Meanwhile, the bottom 20% of earners in this country, they spend like 5 to 10% of all the money that gets spent. So the highest earning individuals in the United States have a disproportionately high contribution to overall consumption. And something very interesting to point out here is that to qualify in that sort of cohort of being in the top 20%, the hurdle is actually not that high. It's a little over $100,000 per year in income, which is like not insignificant, right? But I mean, we're not talking about, you don't have to be making $1 million a year to be in the top 20% of earners. You just got to earn 100 grand, and then all of a sudden you're in the top 20% of earners. You're the ones that are having this, again, outsized impact on growth. Now, let's think about some of the tailwinds that I mentioned earlier, right? When we think about what's going on with stock prices, S&P 500, 6,400, 6,500, who is more likely to own stocks, either in a taxable brokerage account or a retirement account? The top 20% of earners in the United States or the bottom 20% of earners in the United States? Very obviously, the top 20%. If you're making 15 grand a year, you do not have discretionary income to build out a 401k or taxable brokerage account. Now let's think about home equity, right? The value of homes. Let's think about the insulation from the impact of higher interest rates. Who is more likely to own their home? The top 20% of earners in the United States or the bottom 20% of earners in the United States? obviously the top 20%. So the top 20%, they're disproportionately homeowners. They're enjoying all this home equity. Their mortgage payment is about as low as it's been. The bottom 20% cannot get onto the property ladder. They have no home equity whatsoever, and the rental market's on fire, which means they're constantly getting priced out of the market. Then you throw in some of these headwinds that you mentioned, like rising credit card delinquencies, the end of the moratorium on student loan repayments. Who do you think that impacts more, the top 20% of earners or the bottom 20% of earners? If you make 100 grand a year, you probably require some sort of financial aid, of course. But if you make $1 million a year or 500 grand a year, maybe you don't. So, like when we think about this economy, you are looking at the sort of the top 20%, the highest income, wealthiest individuals doing extraordinarily well. The bottom 20%, the poorest individuals doing extraordinarily poorly. But at the end of the day, what matters more is that the rich people are doing well than the poor people are doing poorly. And so you can see an economy that continues to grow and consumption that continues to grow, even with these issues that you've pointed out. What you end up with is more of a political problem, where like the wedge between the haves and have-nots gets driven further and further and further. And it's one of the reasons why you've seen such a dramatic rise in populism kind of across the aisles, right? Democrats and Republicans are all about populism right now. And I think one of the reasons for that is this growing divide between the wealthiest and the poorest in the U.S. So that's I think kind of where we are from a consumption dynamic. It's pretty interesting.
Yeah, so these so-called cracks are more like potholes on the highway than anything else. They make the ride bumpier and grab your attention, but they're not the kind of thing that usually blows up the whole engine.
It's not going to blow. It's not going to blow up the whole engine in the sense that it's not going to push us into a recession anytime soon. It could blow up the whole engine in the sense that if like half of your population is essentially on food stamps, think about all the government spending that needs to get done to make sure that these people aren't dying on the streets from malnutrition. And think about what all that government spending does to the fiscal position. And think about what a blow in deficits and the debt load does to the interest rate environment and to the growth story. So like longer term, populism always weighs on growth. It's always inflationary. It always pushes long end interest rates higher and makes things ultimately less affordable. But shorter term, in a more micro way, no, it's not going to push us into a recession. Like the economy will be fine for a while, I would say.
Right.
So Jack, we speak a lot about the consumer, which makes sense because, to your point, makes up roughly 70% of GDP. But how are you looking at the labor market and how reliant the consumer is spending to contribute to GDP? How reliant are those consumers on the potentially slowing labor market? We've seen some payroll readings the past few months with pretty steep revisions downward. What are your current views on the labor market?
The labor market's another interesting one, and I think I think there are some dynamics going on underneath the surface in the labor market that aren't discussed as much as they probably should be. It's not to say nobody's talking about them, but they're not the things that are grabbing attention in the way that, to your point, Mark, like the most recent jobs report did, where not only did you see payroll gains for the month of July come in significantly below expectations, but then you also saw some massive downward revisions to the previous 2 months of data that brought that kind of run rate 3-month number to like 30,000 payroll gains, which is super, super low for the U.S. economy. That's what grabs the headlines. But to me, what's going on right now is much less a labor demand story, which would be sort of reflected in these payroll figures, and much more in a labor supply story, in the sense of like the number of people that are there eligible to work. And one of these really interesting statistics that we like to look at is population growth to some extent, but also labor force growth in particular over these past couple of decades. And one of the things that you've seen in the U.S. is that our own domestic demographics are really working against us, right? You have an aging population with the baby boom rolling out of the workforce. You have a declining birth rate, right? Americans are waiting longer to have children. When they do have children, they're having fewer children than they had in the past. Neither one of these things is going to get fixed anytime soon, particularly that birth rate side of things. It's not going to get fixed anytime soon. And if our own domestic demographics are bad enough that, believe it or not, the Census Bureau actually projects that the native born population of the US is going to start to shrink in the next 10 years,
Hmm.
got to find some sort of plug out there to make up for that shortfall. And that plug can come in two different forms. The plug can come in the form of more productivity, which is what a lot of people are like fingers crossed, Hail Mary, hoping that AI does for them, right? It like makes this shortage of workers less of a problem because AI makes us all so much more productive and efficient or whatever. Or you can augment the labor force by importing it, right? And you import labor through immigration. And if you look at the most recent numbers out of the Bureau of Labor Statistics, you'll see that foreign-born workers make up the vast majority of labor force growth over these past several years. And we know that Washington is making some very significant adjustments to immigration policy. Obviously, a lot of that's focused on the undocumented side of immigration, which doesn't necessarily get captured in the jobs reports, but it will have knock-on effects on the documented side of immigration as well. There might be a general cooling effect where foreigners are less interested in coming over here to study, for example, to work, especially if federal grants start to get dried up. You may see more voluntary deportations for one reason or another. All this means, right, is that you're looking at a structurally tight supply of labor, basically a chronic labor shortage right now. And I think with that in mind, it helps to kind of explain what's been going on the payroll side of things, right? Because this economy is still growing, consumption is still growing, more clarity on the trade front has improved sentiment. Confidence is higher than it was a few months ago when it was at a near all-time low. Businesses are still interested in spending and in hiring. Yes, they're less interested than they were 6 months ago because conditions are more uncertain now than they were 6 months ago. But also, when they do decide they want to hire, they're having a much harder time finding the right worker because that supply of labor is shrinking. The growth rate there is coming down considerably. And that's why you end up seeing jobs reports like the one that we saw last month that show payroll gains that are super, super low, but an unemployment rate that is still about as low as it's been in history and wage growth that's still pretty darn high. And this, I think, ultimately comes back to what Austin and I were talking about right at the sort of get-go of this. You know, when you think about what's going on in the labor market, even anecdotally, businesses aren't really firing a lot of people. They're also not really hiring a lot of people. We're sort of in this stagnation period for labor where, like, if you got a job, it's great. And if you don't have a job, it's really, really, really hard to shoe yourself in. And, does that mean the economy can keep on growing? Yeah, probably. Does it mean that you're also dealing with like a whole underclass of individuals, particularly young people that like are unemployable for one reason or another? Also, yes. And that has its own kind of long-term implications. But, we're thinking about the data and what's right in front of us. That tight labor market on the back of a labor supply shortage, I do think is supportive of continued growth, just perhaps a little bit slower.
I'm glad you brought this up because irrespective of where you stand politically, immigration policy clearly affects the labor market, right?
Yes.
You can think of immigration like turning a faucet on or off. When the flow of workers slows to a trickle, businesses fight over the same small pool of talent, wages climb, increasing wages can keep inflation sticky. Do you see immigration as an underappreciated driver of inflation and Fed policy?
It could be.
Okay.
It could be in a fairly interesting way, actually, because I mentioned the sort of difference between documented and undocumented labor, and that the undocumented side of labor, sort of by definition, doesn't necessarily get picked up in a lot of the official statistics. But if you think about, and again, this is sort of anecdotal, but it's also mostly true. If you think about what sectors benefit disproportionately from undocumented labor, it's going to be things like construction. It's going to be things like agriculture, like farming. It's going to be things like back of house staff, whether that's like a line cook or a busboy or whatever. These are the individuals that, well, actually, let me rephrase that. Those are the jobs that will disproportionately benefit from undocumented labor. So like construction and let's call it like the restaurant industry. You know what the two biggest sources of inflation are right now? If you look at CPI, it's shelter costs because there aren't enough homes out there. And so people have to pay more to rent. And it's spending on travel, leisure, hospitality, fun, because people have labor is at something of a premium, and people with disposable income use that disposable income to go out and buy fun stuff, buy fun services. So the two biggest components of inflation today are the two most susceptible components of inflation to further inflationary pressure from changes to the labor mix because of adjustments to immigration policy. So, I mean, I don't think this means we're heading to 7, 8, or 9% inflation. Like, I wouldn't go that far, but I do just think it's interesting that like the two areas where inflation's been the most sticky, the most persistent, are also the two areas that are most likely to see more inflation because of changes to immigration policy.
And speaking of inflation, a lot of the headlines and a lot of what you hear are a debate, right, on tariffs and tariff policy, trade policy, and that's that overall effect on inflation, whether that's going to ramp up inflation, or if it's more of one-time price hikes that inflation will continue to drive lower, but maybe a little more rocky road lower from here. How do you see that playing out?
From where I sit right now, Mark, I would say that any sort of tariff related inflation will be, and not to use a dirty word, but will be transitory, will be something that only lasts for about 12 months or however long the duration is once the dust finally settles. Because tariffs are, in theory, a one time adjustment higher in prices, right? Because inflation is the rate of change. It doesn't mean that 12, 18 months from now, prices will be lower. It just means they won't be growing at the same rate as they're growing, right now, or might be growing in a couple of months. The threat to that narrative, though, is if inflation expectations start to get untethered, I guess is the word that I would use. And the way I think about inflation expectations, and maybe it was just me, but let's see if this resonates at all with you. Like, I remember, in the aftermath of COVID, like whenever you went out to go try to buy something, it was always so much more money than you thought it was supposed to be because there were all these problems going on with the economy, whether it was a labor shortage or supply chain problems because of zero COVID in China or like whatever it happens to be. Like you'd go out to you out to dinner or whatever in early 2022, and you'd open up a menu, it'd be like, how much is a glass of wine? Like, how much is that plate of pasta? That's crazy. But then you just kind of throw your hands up and say, oh, well, it's COVID. That's just the way it goes. You don't know actually what's going on underneath the surface for that restaurant's input costs, right? You don't know if that restaurant actually needed to raise prices by 5 or 10%. But the restaurant knows that you're expecting them to raise prices by 5 or 10% because you're reading all the headlines about the labor shortage and about the goods shortage and about the food shortage. And so you expect that prices will go higher. That's kind of the risk, I think, longer term to the inflation outlook is that tariffs in reality are just like a one-time hit to prices, but that companies latch on to the tariff narrative and sort of pass on higher costs that purely pad margins under the guise of those higher costs being related, in fact, to tariffs. And so I think that's where there's a little bit of risk. Again, kind of like what I was saying earlier, this doesn't mean 7, 8, 9% inflation, but it does suggest, I think, that there's further evidence here that like the 1.5 to 2% inflation days that we saw before COVID are very, very much behind us, at least for the foreseeable future. I think we are kind of in a new normal, which is a phrase I hate, but I do think it's appropriate right now.
Right. And when would that party end if these businesses are increasing cost and under the guise of inflation, or people just get used to it, so they're just going to continue to do it? When does that party end? When do businesses feel that crunch where the supply demand factors kick in? Is that when it's too late? Is that in a recession, or is that earlier?
That's a good one. Frankly, I mean, my own personal opinion is it probably is a recession is the only thing that kind of jolts businesses into sort of level setting prices back to something that's a little bit more normal. But the other thing that we saw happen, and this was particularly true during like the dog days of inflation in 2022, is that consumers will kind of move down the quality spectrum of whatever potential item it is that they're looking to buy, rather than give up on that item altogether. So, like to give you an example, I have a friend that works for the largest or one of the largest liquor or alcohol conglomerates in the world. He does like corporate strategy for them, which is an interesting job just to begin with. And he was saying that, like, people are still drinking tequila. They're just like not reaching for the Patron anymore. They're like reaching for the Cuervo down at the bottom. They're like drinking the stuff that they drank back in college. Like they still want to drink the tequila. They just can't afford the top shelf stuff anymore. And so you ended up seeing this anecdotally, of course, but also when you're hearing earnings reports from some of the big box retailers, they're like, people are still spending money. They're still out there. But the way that they get around these higher prices is by shifting lower in the quality spectrum. And that might be something that you see happen as well, if companies decide that, like, they can't really continue to ratchet up prices, but they don't want to lower them too much. They may steer consumers that can't afford stuff into a lower quality alternative.
So you're talking about these inflationary pressures, right? On one end. On the other end, the market seems convinced that the Fed's going to cut rates, within the next, with probably this year, right? I think the Fed, the market's pricing that in. Certainly within the next 6 to 12 months. I think just doing a couple Google searches, you could all of a sudden make a strong case for it. How do you see the Fed's next moves playing out?
So I think, to your point, Austin, like the September rate cut is basically done. It's locked and loaded. Powell teed that up at Jackson Hole very, very clearly. And I think that any sort of shadow of a doubt was sort of cast away as soon as you started hearing more about like the changes to the Fed's underlying structure and new people being appointed and other people getting ousted and whatever. Like there's very clearly just a lot of talk around the Fed beginning to cut rates, and I think frankly they will in September and maybe once more before the year is over. But when I think about interest rate policy, and the way that I approach it is to, first of all, kind of throw my hands up and say, like, I don't know, like nobody really knows. The Fed doesn't know exactly what it's going to do. Very clearly, the Fed doesn't know exactly what it's going to do. But what I do know is that inflation is not going to be coming down a lot, because there are some floors in here, like spending on shelter or spending on fun or whatever it is. Mm-hmm. It's also not going to be hitting like 7, 8, or 9%, because the last time we were there, we were dealing with the greatest supply chain problems the world has ever seen. And that's not what trade and tariffs and immigration policy are going to do. So we're looking at inflation that's a little bit warmer than normal, which means that, okay, the Fed doesn't really need to cut a whole lot. On the flip side, though, Powell has made it very, very clear in terms of his like spoken commentary at press conferences, at speeches, also the summary of economic projections and dot plots that he publishes, that the Federal Reserve publishes on a quarterly basis, that he still views rates right now to be restrictive. We are not in neutral territory from a Fed funds rate perspective. We are in restrictive territory. And with so much uncertainty out there from a policy perspective, from a macro perspective, having rates in restrictive territory, to me, does not make sense. Like, why not idle in neutral and then throw it into gear or throw it into reverse, depending on what actually happens over these next 6 months? So that, I think, justifies 1 or 2 cuts, with the broader inflationary narrative saying, and that's why it's not going to be 3, 4, or 5 cuts, right? So that's kind of where I land on this, at least over the next 6 to 12 months. A little bit of easing, clearly a bias towards easing, but no real need to meaningfully lower interest rates anytime soon.
I feel like everyone's waiting for the Fed to show up like Oprah, you get a cut and you get a cut and you get a cut. But it's not that kind of show, to your point. Large cuts could be very bullish, but small, cautious cuts are more like the Fed buying insurance, I guess, just in case the economy slows. They're not trying to stimulate growth. They're just putting a safety net in place. And I guess that doesn't have to be a bad thing, right? I believe in 1995 there was the soft landing where where the Fed did something similar after raising rates substantially within, I think it was like a course of a year, maybe a little less. There was three, maybe four 25 basis point cuts lower. There were obviously differences back then, but that started one of the biggest bull runs I think we've seen in the U.S.
Yeah, I think a safety net's a good way to put it, and I don't think there's anything wrong with that. And from an economic perspective, certainly there's nothing wrong with that. It's better for the Fed to have more tools in its tool chest to deal with like an actual crisis. And in order to have more tools in its tool chest, it needs to keep rates higher than what we saw in the aftermath of the financial crisis. Because we're at 4.25 to 4.5% right now on the Fed funds rate. You can very comfortably cut by 200 basis points and still be pretty close to having a positive real yield on that Fed funds rate, which is very impressive. Whereas, if you're cutting from 2.25, then all of a sudden you have a lot less wiggle room before real yields become negative and you start to distort the financial system again. So the safety net on the economic side of things, I think, makes a lot of sense. On the market side of things, I think that has to do with kind of how the relationship between the Fed and the market has evolved over these past, several decades. And my kind of crackpot take on all this is that we spent a lot of time talking about, the macro data, policy, and the Fed. I actually don't think the Fed has a whole lot of control over the macro numbers. It just doesn't. I mean, and you've had plenty of evidence of that, right? I mean, the Fed had kept rates at zero in the aftermath of the financial crisis and ballooned its balance sheet to, up until that point, never before seen numbers, and inflation never moved above 1.5%, 2%. On the flip side, you saw inflation surge up to over 9% in the aftermath of COVID, and the Federal Reserve was banging its head against the wall and raising interest rates in an attempt to squash that. But the reason inflation came down was not because of higher interest rates, but because you undid a lot of the factors that were driving inflation to begin with. Like that 9+% inflation print was driven by supply chain uncertainty on food and energy because Russia had just invaded Ukraine, and supply chain uncertainty on finished goods because China was still doubling down on zero COVID. Powell did not reroute the tanker ship. He did not reopen the Chinese factories. These things would have happened with or without higher interest rate policy.
So was it actually transitory?
It actually was. It's nobody wants to talk about fair play. It did take a little bit longer than it should have, but it was absolutely transitory. Absolutely transitory. And I think that they should get credit for the verbiage. I don't think they should get credit for their response because it was heavy-handed in the way that most of their responses have been heavy-handed. Now we're back in another kind of mess that we're dealing with. But on the flip side, the Fed has a ton of control over asset price inflation. The Fed can raise or lower the cost of borrowing and have dramatic amplified ripples in the housing market, in the stock market, in the bond market, in the crypto market, right? I mean, you can see all sorts of things that move alongside changes in interest rates, and changes in asset prices might have an influence indirectly on inflation. If, say, people's 401ks are very valuable and their homes are very valuable and they feel empowered to spend more. But that's where I think a lot of the action actually is. And with the economy becoming so financialized, it is sort of important to have the Federal Reserve there to function as something of a backstop to make sure that you don't just see massive world-ending market moves on account of a policy misstep or something like that.
Jack, how do you view money supply and its effect on inflation, M2 and money supply? And Dr. Kelly at your firm, I was reading, I think a few weeks ago, put out a notes to the week ahead, speaking about the end of monetarism. And it was a pretty fascinating article. What are your views on money supply and its effect on inflation as an indicator?
It is a good read. I always like everything that David puts out, and I would say I generally agree with his conclusions. Although who am I to disagree with them? My boss, I can't disagree that much. One thing that I would sort of maybe not add to the conversation, but maybe use as a point of distillation to the conversation is that the stock of money that's out there And the flow of money that's out there is important, but it is not important in a vacuum. It is important as it relates to all this other stuff that's going on underneath the surface. And actually, a lot of this comes back to, again, an earlier conversation that we were having about the highest income individuals, the lowest income individuals. The the data very clearly show you that the top earners in this country are far more likely to take any incremental, like additional dollar, take that dollar and save it or invest it, right? They're far more likely to use it towards like paying down their mortgage, or they're going to put it into their IRA, or they're going to put it into their taxable brokerage account, or they're like, whatever it is, they're far more likely to take that extra buck and save it or invest it. Whereas the bottom 20% of earners in this country are far more likely to take that extra buck and spend it, right? Because like you make 20 grand a year and you get $1,000 stimulus check in the mail, like that moves the needle in the way that if you make $1 million a year and get $1,000 stimulus check in the mail, it does not. And when you think about a lot of the instances of fiscal stimulus over these past 20 years, and this is a vaguely political statement, but I think the data support it, a lot of this fiscal stimulus, mostly in the form of tax cuts, has disproportionately benefited higher income individuals. And those higher income individuals are much more likely to take that money and, again, save it or invest it. So you got all this money sloshing around out there, and the money printing machine is going bananas, and the flow is crazy and the velocity is crazy. But if you think about the people that are really holding on to that stock and benefiting from the flows of that stock, that extra money does not go into CPI inflation. It goes into asset price inflation. I think that's another reason why you shouldn't think of M2 as like the one indicator that will help to tell you where inflation is going. That relationship's broken down in the past couple of decades.
That makes a lot of sense. Yeah, bifurcating where those dollars are going in the economy, who's spending it, investing it, et cetera.
Exactly.
There's currently has been, wow, messing that up. So in the headlines, there has been a lot of back and forth between Trump and the Fed. Lisa Cook is suing Trump to try to block from being fired. There's speculation about Powell's job security. Every other day it feels like. Is this just political theater, or does this matter for the Fed credibility in the markets?
Tricky question. I think all the headlines are damaging to Fed credibility, just in the sense that like you've never seen or you haven't seen in a very long time, I should say, such a concentrated and focused attack on the membership of the Federal Reserve. Like you just really haven't seen that since the Nixon administration. So for many of us, like this is the first time we've seen something like this. And it feels unprecedented, which makes it feel a little bit scary. So I don't think you can ignore that. But the other thing that I like to point out whenever I have conversations about Fed independence is that the Federal Reserve, as it exists right now, the whole entity, right, with the board of governors and the different presidents of the different banks and the FOMC and all this stuff, they were all created by an act of Congress, which means that the composition or the existence of the Federal Reserve can only be altered by an act of Congress. And unlike what you've seen recently under both the Biden administration and the Trump administrations, where you've seen budget reconciliation bills get passed by the skin of their teeth with like a simple majority because that's the way budget reconciliation works, you would not be able to change or delete the Federal Reserve without a proper majority, a filibuster-proof majority in the Senate, 60 votes. You are never going to get that. You wouldn't even get all the Republicans to sign on to disband the Federal Reserve. So the Fed in its current kind of structure, I think, is more or less here to stay. Mm-hmm. And that's important because unlike a lot of other central banks out there, monetary policy is actually decided on through a vote, right? Because the board, the organization that dictates monetary policy is the FOMC, it's the Federal Open Market Committee. It is a committee, right? And that committee is made up of about a dozen individuals, with the chair typically also being the chairman of the Federal Reserve. So Jay Powell is the chairman of the Federal Reserve. He's also the chairman of the FOMC. Historically speaking, members of the FOMC might dissent, like we saw in the most recent Fed meeting, where you had a couple of people sort of stand up and wave their hands and say, like, I don't agree with this decision. But usually, FOMC members will show deference to whatever the chair wants to do. There is, however, no legal precedent to that story. And so what that means, right, is that you could install as the chairman of the Federal Reserve and kind of by extension, the chairman of the FOMC, someone who is extremely sympathetic to the Trump administration's desires to dramatically lower interest rates. But if you don't have a majority of that open market committee thinking the same thing, you're still going to end up with monetary policy the way that it's been going, just with more dissents and maybe more vocal dissents, and maybe some more kind of firebrandy speeches from whoever that chairman happens to be. It would take a lot to alter the Federal Reserve to meaningfully push interest rates lower. The other thing I would point out here that I think is also equally worth mentioning is that, like, if they do succeed in capturing the Federal Reserve and kind of holding it hostage and making it a sort of extension of the executive branch, they're going to run into a really big problem, which is that you're going to see global creditors, so not just in the US, but all over the place, start to get even more worried than they already are about the US fiscal position. Because one of the major arguments for lowering interest rates is so that we can refinance our debt at cheaper, more sustainable levels. If creditors look at what we're doing and say they're not trying to get serious about the debt situation, they're not trying to wrangle anything in, they're just trying to bring down borrowing costs, that's going to push long rates higher. And if long rates move higher, now mortgage rates move higher, and auto loan rates move higher, and credit card rates move higher. And all of a sudden, this plan is spectacularly backfired and nothing is cheaper. It's actually all more expensive. And so you got like an added kind of layer of security here, I guess I'd say, where any sort of adjustment to interest rate policy has to be communicated in a perfect way so as not to spook global credit markets. And I think that also helps to kind of keep rate policy on the steady, on the straight and narrow, I would say.
Gotcha. So the Fed can be poked, but theoretically there's protections. They're protected. Yeah.
Yeah, exactly. From where we are right now, certainly.
So Jack, you mentioned a national deficit, our federal deficit, federal debt. We just passed the one big beautiful bill this summer, which also should provide some tax cuts to taxpayers. How do you see that overall effect on the economy, the impact of the one big beautiful bill?
The first thing to point out is that the one big beautiful bill, as it currently stands, will be additive to our deficits, which in turn will be additive to our debt, which then goes back to that earlier problem that we were just talking about, which is that the bigger your deficit, the bigger deficit you run, and the bigger your debt load becomes, the higher long rates end up going.
Mm-hmm.
The not counterpoint, but like the little bit of detail on that is oftentimes overlooked, however, is that the organization that scores these pieces of legislation, the Congressional Budget Office, they look at this piece of legislation and they say, all right, this is what it's going to add to the deficit. This is what it'll add to the debt. The CBO does not incorporate tariff revenue into that calculation. And that's because tariffs are not levied by Congress. They were levied through executive action by the president himself. That is ignoring a very large source of funding, right? Like it or not, tariffs brought in about $35 billion in revenue just last month. You annualize that, and you're looking at almost $500 billion coming into the United States through tariff revenues. It means that the one big beautiful bill is still probably additive to the debt deficits, but not as much as what you might see kind of first blush, right? Like looking at the numbers as scored by the CBO.
Right.
And out here is, like, to your point, like a lot of fiscal stimulus in the form of tax cuts, which could goose up consumption. It might also goose up a little bit inflation, although given that tax cuts are generally regressive, probably more on the asset price inflation side of things than the CPI inflation, again, sort of related to what we talked about earlier. And then some pretty significant changes on the spending side of things, right? A lot of savings coming in the form of adjustments to entitlement benefits, particularly work requirements for things like food stamps, but also some changes to the way that student loans are processed, various changes like that. Met by, however, some pretty significant increases in spending on things like border security and defense. So you kind of net out on the spending side of things, although maybe that the spending is a little bit more short term. I'm not exactly sure, but yeah, I think all of this probably gets us to a point where you see a little bit more growth, you see a little bit more inflation, and you see modestly higher interest rates, particularly on the back end of the curve.
So we're running short on time, but I want to bring this back to your thoughts on investment strategy. For investors sitting in excess cash today, is there a case for bonds that you're seeing?
Yes. In fact, like I know this industry has been saying that bonds are back for like several years now, and it hasn't really felt like it. But when I think about fixed income, my big like take on all this is that we have been living in this kind of collective delusion over these past several decades at this point, where we have convinced ourselves that bonds exist to be ballast against the stocks in your portfolio. Like that's the whole idea behind a 60-40 portfolio, is that like when stocks do this, bonds do this, and you're zigging when everything else is zagging, and it's your insurance policy, and like that's why you own it, right? To kind of smooth out the ride. Now, that has not been the case. 2020, 2022, 2023, 2024, and so far in 2025, stocks and bonds have moved in the same direction. And yeah, I guess it's nice to be able to clip a pretty healthy coupon, right? And without a doubt, there's a healthy coupon in fixed income right now. But from that perspective, anybody that's owning fixed income really could look at that portion of their portfolio as simply holding them back, right? Like the bond portion of my portfolio kept me from achieving 25% returns in equities last year. And the bond portion of my portfolio did nothing to protect me from the near 20% sell-off that we saw in 2022. The reality is that fixed income, while it doesn't protect you against the equity market, does protect you against the economy, in the sense that, like, if there is a recession for some reason, the first thing the Federal Reserve is going to do is cut rates. And when interest rates move lower, the value of any existing fixed income instrument that you own goes up. And there is your ballast. There is your insurance policy. So I would say for investors with excess cash on the sidelines, if you are looking at fixed income, and you probably should be, higher quality, short to intermediate duration stuff can play a really interesting role in your portfolio, where it sits there giving off a pretty healthy coupon until the day, whenever it is, that a recession hits, and then you get a really nice total return play as that duration tailwind kicks in.
I love how you clarified that, because I think that's a point where a lot of investors get confused looking back at 2022. 2022 wasn't a recession, and also bonds don't have to work as protection every single time. But what matters is more times than not, historically, that they've held support, especially when we are in a recession. So then on equities, you mentioned a lot of risks today. Are you bullish on stocks?
Sure, you have to be. I mean, betting against the U.S. equity market is the worst bet you can ever make, especially if you are a long-term investor. You get your money called every single time. You got hundreds of years of history to support that story. When I think about how to invest, given the kind of uncertainty, given the risks, to your point, Austin, that are out there, I think the play has to be quality. And I was in Chicago last week talking with a client, and he came up afterwards after the presentation. He was like, everybody says quality, but like, who wouldn't want to buy a high quality asset? Like, why would you want to buy a low quality asset? But the flip side to that, when you talk about quality, is that small cap stocks are not a high quality play, right? In the sense that they carry more debt, their profitability story is a little bit more challenged. There are plenty of reasons to buy small cap stocks. A lot of people love small cap stocks. There's a really compelling valuation argument in small cap stocks right now. But if I'm playing it safe, if I'm playing quality, then I'm going to lean more into large cap markets. When I think about quality, I would say that U.S. markets are, generally speaking, higher quality markets than their international peers. I'm not a huge fan of investing overseas. I've never been. So just kind of putting my cards down on the table. I've always been kind of a US bull. I believe very firmly in US equity market exceptionalism. I don't think that's what's happened over the last 8 months has changed that story at all, at least not for the long term. So I'm thinking large cap and US. So now you're kind of talking about like the S&P 500 is your hunting ground. For a while, it's been only the Mag 7, and that's worked pretty well. But it's also resulted in valuations that are pretty stretched and a market that's very, very concentrated in a very small handful of names. What we're looking for right now is a broadening out of earnings within the S&P 500, which we expect to see. It's already starting this year, but we really think it's going to gain legs next year. And I think it really underscores the importance of bottoms-up security selection and active management right now. So, yeah, I mean, I'm always long-term constructive on U.S. stocks, but even shorter term, I can stay constructive by really focusing in again on that larger pocket of those names, and then relying on security selection and active management to find the winners and the losers.
It sounds crazy for me even to suggest this, but do you feel like a contrarian with your bullish US large cap stance? I mean, there's been a lot of commentary lately which favors US small caps and international.
Sometimes, I mean, more often than not, in fact, I do. I mean, in fact, just this morning, I was chatting with some other people here at JP Morgan about the kind of international outlook. Like, I don't believe the narrative that U.S. exceptionalism is over. I don't believe that this sell America thing is going to stick around. In fact, it's already unwound quite a bit. I think the dollar is oversold and will likely bounce back. I think the underlying drivers behind foreign markets are very much like one time, rebases higher rather than some sort of secular shift. And I think that the United States has been the engine of global technological innovation for the last several decades, and that is not going to change anytime soon. And then on the small cap side of things, I mean, when do small cap stocks outperform? They outperform when the U.S. economy is doing very well because they are more domestically levered, and they outperform when the U.S. dollar is extremely strong because they import a lot of stuff and then turn around and sell those imported goods to American consumers. And the U.S. economy grew like 4% last year, and the dollar was as high as it had ever been, and small caps stunk. So, like, if you're looking at an economy that's now slowing down and the dollar that's weakened, why is it a better environment for small caps where 50% of the Russell 2000 doesn't make any money and all these names have floating rate debt that's either been maturing or is about to mature at much higher levels than when they took it out? So, yeah, sometimes I feel like, I don't know if you've ever seen Zoolander, but sometimes I feel like I'm taking crazy pills when I have these conversations. And yeah, I mean, maybe it does make me a little bit of a contrarian, but and kind of boring too, frankly. But large cap, U.S., steady Eddie, I think it's a good place to be still.
Yeah, I mean, one of the things you have to love about the market is competing views, right? The market represents the competing views of the brain trust that is all investors. So certain things are priced in, right, and you're rewarded less. Other things are not. And at the end of the day, all you could say is, let me stick to a disciplined long-term strategy, right? And then all we can do is, play the cards as they're dealt to us as things develop, right? And as the market continues to climb that wall of worry until one day it doesn't, and you got to reposition and back at it.
Exactly right.
So lastly, Jack, I appreciate your time. Just to kind of get out of the thick of it here, now that summer's behind us and we're heading into year end, what's something you're most looking forward to? And it doesn't have to be, it can be market related, it doesn't have to be market related.
No.
In fact, prepreferably, it'd be great if it's personal. So, what do you have that you're looking forward to?
Yeah, nothing market related. In terms of something that I'm sort of bittersweet about, the summer's been nice because I haven't done a lot of travel for work. That is starting up again next week, and basically every week from now until after Thanksgiving, I'm on the road somewhere talking with clients. I love it, but it's also exhausting. So I'm sort of looking forward to that if we want to make like a work thing that I'm looking forward to. But at a personal level, what I'm really looking forward to is in just under 3 weeks, I'm flying off to Tokyo. First time in Asia, spending 2 weeks in Japan with my best friend. We've taken a trip every single year, almost since we graduated from college. And this year is our 10th anniversary. So we decided we got to go do something big, hence this 2 week blowout in Asia. So that is what I am really, really excited about now that Labor Day has come and gone, and stuff gets more serious pretty quickly.
That's awesome. That's
I
awesome.
love it.
Gives me something to look forward to. I actually have a trip that I do with some of my high school friends. We go to a new state every year. We haven't gone overseas yet, but that's on the menu. But seeing that you've been able to keep up that tradition for so long gives me extra hope that we can continue on. Life gets crazy once the kids and the families and the work and this and that starts. So
it's the best. I wish you luck on that. It's my favorite thing every year.
very cool. Well, enjoy the trip, and thank you again for joining us.
Yeah, it was a pleasure seeing you guys. Thank you, Austin. Thank you, Mark. This was a lot of fun.
Great. Thank you,
Likewise.
Mark.
Thank you, Jack.
And thank you, viewers. Please remember to like and follow us, and don't be afraid to hit that share button. Great. Thank you.
Take care.